The chair now recognizes the ranking member of the subcommittee, the gentleman from California, Mr. Sherman, for 4 minutes for an opening statement.
The SEC oversees our capital markets, which is the nerve center of global capitalism. Virtually all of the most powerful companies in America and really the world have functioned with one goal: increase the value of their company securities in our capital markets. Our capital markets are the envy of the world, and the securities traded there are worth over $100 trillion. So I don't think it's a good idea to let big balls just take a whack at it. Whether it's crime in the streets or crime in the suites, we should not defund the police. The SEC more than pays for itself. It's got a $2 billion budget. It secured over $8.2 billion in fines last year and returned $3.2 billion to investors. And one thing I'm concerned about is insider trading. We saw this when, for 1 week, everybody knew when Trump got elected, crypto would go up a bit. And Bitcoin went up 22% in that first week. But Dogecoin went up 135%. During that week, there were only a couple of people who knew that this commission would get this weird name designed to advertise one crypto coin. I don't know who knew that, but I do know that Elon Musk is more powerful than any one member of Congress. I'm humble enough to say that. But Musk does not file any of the financial reports that we have to file. We will see a couple years from now whether we see $8.2 billion a year returned by the new SEC in fines and a $3.2 billion to investors. If not, it will not be because there are no crooks on Wall Street. The wolves of Wall Street are not going to become lambs. It will be because the SEC was defanged and or defunded. Business needs capital, particularly small and medium-sized business. Traditionally, that was banks. But we've told all the banks they can't even make any prime plus 3, prime plus 4 loans. We need to focus on bank regulation. We need to allow credit unions to make more business loans. We need to allow the BDCs to play their role in developing businesses. That's why I've got the Access to Small Business Investor Capital Act, which I introduced in the 116th, 117th, and 118th Congress. I will be reintroducing it in the 119th Congress and look for as many co-sponsors as possible. Finally, our banking system discriminates against business loans by saying that if the banks instead deploy their money into marketable securities, they don't have to mark-to-market their losses, particularly those securities they list as being ones they plan to hold to maturity. As to the accredited investor definition, it needs work, but not just expansion, but also contraction. The idea that somebody is high income because they have $200,000, keep in mind, members of Congress, if they get reimbursed for their living expenses here in Washington, are listed as having incomes of $200,000, and not a single one of my colleagues has said that the congressional pay package represents high income, and $1 million does not make you wealthy in the current system. When we passed these laws, it was back in the 70s. Prices have gone up by a factor of 7.7. So we've seen an erosion of the definition of accredited investor when based on wealth to the tune of 7.7 times. We need to change those numbers on the one hand, and, as the chairwoman points out, also account for the fact that people who don't have high income, don't have high wealth, may have high knowledge and ought to be listed as accredited investors. And I yield back.
The chair now recognizes the ranking member of the subcommittee, Mr. Sherman, for 5 minutes for questions.
As our first witness pointed out, 90% of these startups fail, but it is a national interest to see them funded because the 10% that succeed can revolutionize our society. That's why we need to make sure that these companies are able to get bank loans, that BDCs are able to invest, and that individual investors can invest. But we want to protect the individual investors. Republicans have often said that there's been a decline in the number of public companies, and therefore there shouldn't be, and that's because we put too many burdens on public companies. If you want to register securities, it's not that easy. But another reason why there are fewer public companies is that we've made it easier to stay private. And nothing is a greater example of that than the definition of accredited investor, which in effect has been over 90% repealed. Well, you might ask, well, the statute's the same. Yes, the statute says $1 million makes you wealthy because it was passed in the 70s. That today would be $7.7 million. So we have by inaction, I think any statute that we pass that doesn't have an inflation adjustment in it is a mistake. And this one is a big mistake. It hasn't been adjusted for a long time. So we have made it much, much easier to be an accredited investor on the wealth and income standard, assuming that's even the right standard. Ms. Thornton, we have another rule, and that is a company becomes public if it has 2,000 beneficial owners. But we got a giant loophole. First of all, we allowed the SEC to take that from 500 to 2,000. Arguably, it should be taken back. But when we count beneficial owners, if there are 5,000 customers of Merrill Lynch who all have chosen to invest in a single security, those 5,000 people, how many do they count as under this rule?
Probably one.
One. That is new math taken to a whole new level. If we're going to have a limit on beneficial owners, and I think we should, we have to see through the street name. And it is convenient to hold the security in street name, but we can count the beneficial owners. As to accredited investors, a lot of our discussion here is on how to reform that. We have now a standard based on wealth and income, and really, we set those standards in the 70s, so they're crazy. But wealth and income, even why are those relevant? They either connote knowledge on the theory that rich people know a lot about money, sometimes, or ability to absorb the loss. I would say that we ought to devise standards that are focused on knowledge, MBA, CPA, maybe attorneys, or the advisory team that it must be truly independent, and focus on ability to absorb a loss. Because our current rule makes you an accredited investor to invest 5 or 10% of your money in one of these startups, or 120% of your net worth in one of these startups. We value your wealth based on how much money you have, independent of your home, but then we say you can put a mortgage on your home, now that you're an accredited investor, to invest in a company with a 90% likelihood of failure. So I look forward to working with a definition of accredited investor that focuses on limiting the percentage of one's net worth or income that you're investing in any one issuance, limiting what you put into all private companies, and focusing on knowledge of the investor or their truly independent advisory group or advisors. But to have wealth or income, the idea that somebody has an income of $200,000 and therefore is highly knowledgeable and expert. Again, my colleagues have incomes of $200,000 just for working in Congress, and only some of them are geniuses. So I look forward to working on that, and I yield back.